All right, reading 51 of the CFA Level 1 program curriculum, Fixed Income Markets, Issuance, Trading, and Funding. Learning outcomes, the candidate should be able to describe classifications of global fixed income markets, describe the use of interbank referred rates as reference rates in floating rate debt, describe mechanisms available for issuing bonds in primary markets, describe secondary markets for bonds, describe securities issued by sovereign governments, describe securities issued by non-sovereign governments, quasi-government entities, and supranational agencies, describe types of debt issued by corporations, describe structured financial instruments, describe short-term funding alternatives available to banks, describe purchases, agreements, or repos, and the risk associated with them. Introduction, global fixed income markets represent the largest subset of financial markets in terms of numbers of issuance and market capitalization. These markets bring borrowers and lenders together to allocate capital globally. The most efficient uses, fixed income markets include not only publicly traded securities such as commercial papers, notes, and bonds, but also non-publicly traded loans. At the end of 2010, the total amount of debt and equity outstanding was about $212 trillion globally. The global fixed income market represents approximately 75% of the total. Simply put, global debt markets are 3 times larger than the global equity markets. Understanding how fixed income markets are structured and how they operate is important for debt issuance investors. Debt issuance have financing needs that must be met. For example, the government may need to finance an infrastructure project, a new hospital, or a new school. A company may require funds to expand its business. Financial institutions may have funding needs, and they are among the largest issuers of fixed income investors. Thus, investors need to understand the characteristics of fixed income securities, including how these securities are issued and traded. Among the questions, this reading addresses the following: what are the key bond market sectors? How are bonds sold, primary markets, and traded in secondary markets? What type of bonds are issued by government-related entities, financial companies, and non-financial companies? What additional sources of funding are available to banks? Overview of global fixed income markets. Although there is no classification of fixed income markets, many investors and market participants use criteria to structure fixed income markets and identify bond market sectors. This section starts by describing the most widely used way to classify fixed income markets. Classification of fixed income markets. Common criteria is used to classify fixed income markets include the type of issuer, the bond credit quality, maturity, currency denomination, the type of coupon, and where the bond are issued and traded. Classification by type of issuer. One way to classify fixed income markets is by type of issuer, which usually leads to identification of 3 bond market sectors: the government-related sector, the corporate sector, and the structured finance sector. The government-related sector includes the bonds issued by supranational or international organizations such as the World Bank, sovereign national governments, non-sovereign or local governments such as provinces, regions, states, or cities, and quasi-government entities that are either owned by or sponsored by governments such as rail services and utilities in many countries. The corporate sector refers to the bonds issued by financial and non-financial companies. This structured finance sector includes bonds created by securitization, a process that transfers private transactions between borrowers and lenders into securities traded in public markets. Exhibit 1 provides data on global capital markets at the end of December 2010. As mentioned in the introduction, the combined sectors of global debt markets and 3 times larger than the global equity markets. Exhibit 1 also indicates that the largest issuer of bonds are governments and financial institutions. However, the last column shows that the immediate aftermath of global financial crisis that started in 2008, the amount of bonds issued by governments increased, whereas the amount of bonds issued by financial institutions decreased. In addition, the last 2 columns in Exhibit 1 shows that the sector that grew the fastest between 1990 to 2009 was securitized debt instruments, but it was also the sector that shrank the most after 2008. Securitized debt instruments, also called asset-backed securities, are created by securitization. Securitization involves transferring ownership of assets from the original owners to a special legal entity. The special legal entity that issues securities backed by the assets, and the assets' cash flows are used to pay interest and repay the principal owed for the holders of the securities. Assets are typically used to create securitized debt instruments, including loans, such as mortgage loans, and revisable, such as credit card receivable. Securitized debt instruments are not discussed in this reading, but rather the reading on asset-backed securities. The last row is a reminder that although the focus of many market participants and its reading is on publicly traded securities, banks' loans remains an important component of global capital markets. In many countries, bank loans are the primary source of capital, particularly in small to medium-sized companies. Exhibit 2 shows the amount of debt and equity outstanding and the total capital as a percentage of GDP for various country and economic areas at the end of the December of 2010. It indicates the financial markets relative to GDP are much smaller in emerging countries and developed countries. Debt and equity capital represents more than 400% of global GDP in the United States, Japan, Western Europe, versus less than 200% in Central and Eastern Europe and Commonwealth of Independent States, Latin America, Middle East, and Africa. Classifications of credit quality. Investors who hold bonds are exposed to credit risk, which is the risk of loss resulting from the issuers failing to make full and timely payments of interest and or principals. Bond markets can be classified based on the issuer's credit worthiness as judged by credit rating agencies. Ratings of Baa3 or above by Moody's Investor Services or BBB minus or by the Standard & Poor's S&P. The Fitch rating are considered investment grade. In contrast, ratings below those levels are referred as non-investment grade, high yield, speculative, or junk. An important point to understand is that credit rating are an assessment of the issuer's credit worthiness. At a certain point in time, there are not a recommendation to buy or sell the issuer's securities. In addition, credit rating are not static. They will change if a credit rating agency perceives that the probability of default of an issuer has changed. One of the reasons why the distinction between investment grade and high yield bond markets matters is because institutional investors may be prohibited from investing in or restricting in high yield bonds. Holding generally arise because of more restrictive risk or reward profiles. That forms part of the investor's investment objectives and constraints. For example, regulated banks and life insurance companies are usually limited to invest in highly rated securities. In contrast, the sovereign wealth fund of both Qatar and Kuwait have no formal restrictions on what types of assets they can hold or on the percentage split between bond market sectors. Globally, investment grade bond markets tend to be more liquid and high yield than high yield bond markets. Classification by maturity. Fixed income securities can also be classified by the original maturity of the bond when there are issued securities that are issued with maturity at issuance, ranging from the overnight to over year on money market securities. Some of these securities are issued by sovereign payments such as treasury bills. The corporate sector also issues fixed income securities with short maturities. Examples include commercial papers and negotiable certificates of deposits, which are discussed in section 6.2 and 7.2.3 respectively. In contrast, capital market securities are securities that are issued with original maturity longer than 1 year. Classification by currency denomination. One of the critical ways to distinguish among fixed income securities is by currency denomination. The currency denomination of the bond's cash flow influences which interest rates affect the bond's price. For example, if a bond is denominated in yen, its price will be primarily driven by credit quality or the issuers around the Japanese interest rates. Exhibit 3 presents data on the currency denomination of international bonds, which are bonds issued by entities outside of their home markets, either in their domestic currency or in a foreign currency. It also shows approximately 79% of international bonds are denominated in either euros or US dollars. Classifications of types of coupons. Another way to classify fixed income markets by the type of coupons. Some bonds play a fixed rate of interest. Others called floating rates bonds or floating rate notes or floating raters play a rate of interest that are adjusted to market interest rates are at regular short-term intervals. Demand and supply of fixed rate versus floating rate debt balance sheet risk management consideration explains much of the demand and supply of floating rate debt. For instance, the funding of banks, that is the money banks raise to make loans to companies and individuals, is often short term and issued at rates that change or reset frequently. When there is a mismatch between the interest paid and the liabilities and the interest received on the assets. Banks are exposed to interest rate risk, that is, the risk associated with a change in the interest rate, and effect to limit the volatility of the net worth resulting from interest rate risk. Banks that issue floating rate debt often prefer to make floating rate loans and invest in floating rate bonds or in other adjustable rate assets. In addition to institutions with short-term funding needs, demand for floating rate bonds comes from investors who believe that the interest rate will rise. In that case, investors will benefit from holding a floating rate investment compared to fixed rate ones. Reference rates. The coupon rate of a floating rate bond is typically expressed as a reference rate plus a spread of margin. The spread is usually set when the bond is issued and remains constant until maturity. It is primarily a function of the issuer's credit risk at issuance. The lower the issuer's credit quality, the higher the spread. The reference rate, however, resets periodically. Therefore, the coupon rate adjusts to the level of market interest rates upon each time the reference rate is reset. The choice of the reference rate is critical because the reference rate is primarily deliverer of the bond's coupon rate. Thus, the issuer's cost of financing and the investor's return from investing in a bond depends on the reference rate. Although there are LIBOR rates for currencies such as the euros and the yens, alternative interbank or offered rates may be used for floating rate debt issued in the currencies such as the Euro Interbank offered rate or the Eurobar, and the Tokyo Interbank offer rate, the Taibar, respectively. A similar sets of interbanks offered rates exist in other markets. For instance, the Singapore Interbank offered rate, the SIBAR, the Hong Kong Interbank offer rate, the HIBAR, and the Mumbai Interbank offer rate, the MIBAR. Are all examples of the LIBOR rates of different countries. Classification by geography. A distinction is very often made between a domestic bond, foreign bond, and Eurobond bond. Bonds issued in a specific country denominated in the currency of the country, and so to that country, are classified as domestic bonds if they are issued by an issuer domiciled by a country, and a foreign bond that are issued by the issuer of another country. Domestic and foreign bonds are subject to the legal, regulatory, and tax requirements that apply in the particular country. In contrast, a Eurobond is issued internationally outside the jurisdiction of the country in which the currency, the bond, is denominalized. The Eurobond makes the Euro market has traditionally been characterized by less reporting, regulatory, and tax constraints than domestic and foreign bond markets. These few constraints explain why approximately 80% of entities that issue bonds outside the country of origin chooses to do so on the Eurobond market. Classification of fixed income markets. There are various ways of classifying fixed income markets. Market participants may classify fixed income markets based on some specific characteristics associated with the fixed income securities, specific market sectors that are of interest to some investors, and inflation-linked bonds are in some jurisdiction tax exempt. Inflation-linked bonds or linkers are typically issued by governments, government-related entities, and corporate issuers that have an investment grade rating. They offer investors protection against inflation by linking the coupon payment and or the principal payment to the index of consumer prices. Tax-exempt bonds can only be issued in those jurisdictions that recognize such tax exemptions. In the U.S., for example, there is an income tax exemption for some of the bonds issued by governments or by some of the nonprofit organizations. In particular, the local governments can issue municipal bonds or munis that are tax exempt. Fixed income indexes. A fixed income index is a multi-purpose tool used by investors and investment managers to describe a given bond market or sector, as well as to evaluate the performance of investments and investment managers. Most fixed income indexes are constructed as portfolios of securities that reflect a particular bond market or sector. The index construction, that is the security selection and the index weighing, varies among indexes. Index weighing may be based on price or value, the market capitalization. There are literally dozens of fixed income indexes globally, capturing different aspects of fixed income markets. Discussed earlier, one of the most popular is the Bloomberg Barclays Global Aggregate Bond Index, which represents a broad-based measure of the global investment grade fixed-rate bond market. It has an index history beginning in 1st of January 1990 and contains three important components: the U.S., the U.S. Aggregate Bond Index, the Pan-European Aggregate Bond Index, and the Asian Pacific Aggregate Bond Index. With respect to emerging markets, one of the most widely followed indexes is the J.P. Morgan Emerging Market Bond Index, or the MBI, which includes U.S. dollar-denominated Bradley bonds. Bradley issues primarily by Latin American countries in the late 1980s under a debt restructuring plan. Another popular set of index is the FTSE Global Index Series. Investors in fixed income securities. An overview of fixed income markets has so far focused on the supply side. Before discussing bond issuers in greater detail, it is important to consider the demand side. Because demand for a particular type of bond or issuer may affect supply. After all, market prices are the result of the interactions between demand and supply. Neither one can be considered in isolation. For example, an increase in demand for inflation-linked bonds as a result of investors' desires to protect the value of their portfolios against inflation risk may lead governments to issue a greater quantity of this type of bond. By issuing relatively more inflation-linked bonds for which there is demand, government may only manage to sell its bonds issued and get the funds required, but it may also benefit from a lower cost of financing. There are different types of investors in fixed income securities. Major categories of bond investors include central banks, institutional investors, retail investors. The first two typically invest directly in fixed income securities. In contrast, retail investors often invest directly through fixed income mutual funds or exchange-traded funds. Primarily secondary bond markets. Primary bond markets are markets in which issuers initially set bonds to invest to raise capital. In contrast, secondary bond markets are markets in which existing bonds are subsequently traded among investors. As with all financial markets, primarily the secondary bond market are regulated within the framework of the overall financial system, as an established independent regulatory authority is usually responsible for overseeing both the structure of the markets and the credentials of market participants. Primary bond markets. Issuance of primary bond markets are frequently Exhibit 5 presents data on the bond issuance. It shows that during the year 2011, the amount of new bonds issued exceeds the amount of bonds repaid at 3.8 trillion globally, a growth rate of approximately 4% in all the largest bond markets. That were more new bonds issuance than bonds repayment in value. Public offering, underwriting offerings. shift registration, auctions. These are ways in which bonds may be issued. Private placement, secondary bond markets. Secondary bond markets, also called the aftermarkets, are where existing securities are traded among investors. Securities can be traded directly from investor to investor or through a broker or dealer to facilitate the transaction. The major participants in secondary bond markets globally are large institutional investors and central banks. The presence of retail investors in secondary bond markets is limited, unlike in secondary equity markets. The key to understanding how secondary bond markets are structured and functions is to understand liquidity. Liquidity refers to the ability to trade securities quickly and easily at prices close to the fair market value. Liquidity involves much more than how quick one can turn a bond into cash. The statement implicitly assumes a long position, but some market participants need to buy quickly when covering a short position, and other aspects of liquidity that is often ignored. And the speed of trading alone does not constitute a liquid market. It can't always buy something quicker by offering a very high price, or selling something quickly by accepting a very low price. In a liquid market, trading takes place quickly at prices close to the security's fair market value. There are two main ways for secondary markets to be structured: as an organized exchange or as an over-the-counter market. The unorganized exchange provides a place where buyers and sellers can meet to arrange their trades. Although buy or sell orders may come from elsewhere, the transactions must take place at the exchange recording and the rules imposed by the exchange. Settlement is the process that occurs after a trade is made. The bonds are passed to the buyer, and the payment is received by the seller. Secondary market settlements for government and quasi-government bonds typically takes place either on a cash basis or on a T+1 basis. Sovereign bonds. National governments issue bonds primarily for fiscal reasons, to fund spending when tax revenues are insufficient or cover expenditures. To meet their spending goals, national governments issue bonds to various types and amounts. This section discusses bonds issued by national governments, often referred to as sovereign bonds or sovereigns. Characteristics of sovereign bonds. Sovereign bonds denominated in local currency have different names in different countries. So these are just examples of different names of different countries. Names may be varied depending on the original maturity of the sovereign bond. For example, U.S. government bonds named Treasury bonds or T-bills when the original maturity is 1 year or shorter. Treasury notes, T-notes, Treasury bills, not Treasury bills, original maturity date that is longer than 1 year and up to 10 years, with Treasury bonds or T-bonds were original maturities of longer than 10 years. In Spain, the sovereign issued by the Tesoro Público is named Letras del Tesoro, or Bonus del Estado, and obligations del Estado, depending on the sovereign's original maturity, 1 year or shorter, longer than 1 year, and up to 5 years, or longer than 5 years, respectively. Although varying rates, some bonds, such as the Consul of the UK, have no set stated maturity dates. The majority of the trading in secondary markets is sovereign securities that were most recently issued. These securities are called on the run. The latest sovereign bond issue for a given maturity is also referred to as a benchmark issue, because it serves as a benchmark against which to compare bonds that have the same features, but that are issued by another type of issuer. As a general rule, as sovereign securities age, they trade less frequently. Credit quality of sovereign bonds. Sovereign bonds are usually unsecured obligations of sovereign issuers. That is, they are not backed by collateral but by the taxing authority of the national government. When a national government runs a budget surplus exceeding the tax revenue over expenditures and primarily source of funding for making interest payments and repayments of principal. In contrast, when a country runs a budget deficit, the source of funds used for the payment of interest and the payment of principal comes from tax revenues, and also by rolling over or refinancing existing debt into new debt. Highly rated sovereign bonds denominated in local currency are virtually free of credit risk. Credit rating agency assigns rating of sovereign bonds, and these ratings are called sovereign ratings. The highest rating is the AAA by S&P. Risk-free, including Germany, Singapore, Switzerland, the Netherlands, the UK. The global financial crisis that started in 2008 resulted in many national governments reaching potentially unsustainable levels of debt. With the pace of spending far exceeding tax revenues, many of these countries suffer a downgrade from AAA to AAA level, including Ireland in 2009, Spain in 2010, and the United States was downgraded by the S&P in 2011. Credit rating agencies make a distinction between debts issued by sovereign local currencies and bonds in a foreign currency. Types of sovereign bonds: we've got fixed rate bonds, floating rate bonds, inflation-linked bonds, non-sovereign governments, quasi-governments, and supranational bonds. Non-sovereign bonds, levels of government below the national level, such as provincial, regional, states, and cities. Issue bonds called non-sovereign government bonds or non-sovereign bonds. These bonds are typically issued to finance public projects such as schools, motorways, hospitals, bridges, and airports. The source of paying interest and repaying the principal includes the tax authority of the local government, the tax flow of the project, and the bonds issue and financing, or special taxes and fees established specifically for the purpose of making interest payments and principal payments. Non-sovereign bonds are typically not guaranteed by national governments, as mentioned in section 2.1.7. Bonds issued by states and local governments in the U.S. are known as municipal bonds, and they offer income tax exemptions. In the U.K., non-sovereign bonds are known as local authority bonds. Other non-sovereign bonds include those issued by state authorities, such as the 16 lenders to Germany. Quasi-government bonds: national governments establish organizations that perform various functions to them. These organizations have both public and private sector characteristics, but they are not actual government entities. They are referred to as quasi-government entities. Although they take different names in different countries, quasi-government entities often issue bonds to fund specific financing needs. The bonds are known as quasi-government bonds or agency bonds. Examples of quasi-government entities include government spending enterprises, GSE in the U.S., the Federal National Mortgage Association, the Federal Home Loan Mortgage Association, and the Federal Home Loan Banks. GSE were among the largest issuers of bonds before the global financial crisis that started in 2008. Another example of quasi-government entities that issue bonds include Hydro, Quebec, and Canada, or the Japan Bank of International Corporation. In the case of JBIC bonds, timely payments and interest and repayment principles are guaranteed by Japanese government. Most quasi-government bonds, however, do not offer an explicit government guarantee by the national government, although investors often perceive an implicit guarantee. Supranational bonds a form of often highly rated bonds is issued by supranational agencies, also referred to as multilateral agency. The most well-known supranational agency are the International Bank of Reconstruction and Development, or the World Bank, the International Monetary Fund, the IMF, and the European Investment Bank, the Asian Development Bank, the African Development Bank. Bonds issued by supranational agencies are called supranational bonds. Supranational bonds are typically plain vanilla bonds. Often floating rate bonds and callable bonds are sometimes issued. Highly rated supranational agencies, such as the World Bank, frequently issue large-sized bonds. Issues that are often used as benchmarks issues when there is no liquid sovereign bond available. Corporate debt. Companies differ from governments and government-related entities, and their primarily goal is profit. The most profitable to stay in existence. Thus, profitability is an important consideration when companies make decisions, including financing decisions. Companies routinely raise debt as part of their overall capital structure, both to fund short-term spending needs as well as long-term capital investments. We have so far focused on publicly issued debt, but loans from banks and other financial institutions are a significant part of debt raised by companies. For example, bank loans and syndicated loans. A bilateral loan is a loan from a single lender to a single borrower. Companies routinely use bilateral loans from their banks, and these bank loans are governed by the bank loan documents. Bank loans are the primary source of debt financing for small and medium-sized companies, as well as for large companies in countries where bonds markets are either underdeveloped or where most bond issuances are from government-related entities. The financial institutions' access to bank loans depends on only the characteristics of financial health of a company, but also on market conditions and bank capital availability. A syndicated loan is a loan from a group of lenders called a syndicate and a single borrower. A syndicated loan is a hybrid between relational lending and publicly traded debt. Syndicated loans are primarily originated by banks, and the loans are extended to companies but also the governments and government-related entities. The coordinator or lead bank originates the loan from the syndicate and processes the payment. In addition to banks, a variety of lenders participate in syndicates, such as pension funds, insurance companies, and hedge funds. Syndicate loans are a way of these institutional investors to participate in corporate lending while diversifying the credit risk among a group of lenders. Commercial papers. Commercial papers is a short-term unsecured promissory note issued to a public market through a private placement that represents a debt obligation of the issuer. Commercial papers were first issued in the U.S. more than a century ago. It later appeared in the U.K. and other European countries, and then in the rest of the world. Characteristics of commercial papers. Commercial papers is a valuable source of flexible, readily available, and relatively low-cost short-term financing. It is a source of funding for working capital and seasonal demand for cash. It is also a source of bridge financing, that is interim financing that provides funds until permanent financing can be arranged. Suppose a company wants to build a new distribution center in Southeast China and wants to finance this investment with an issuance of long-term bonds. The market conditions for issuing long-term bonds may currently be volatile, which will translate into higher costs of borrowing. Rather than issuing long-term bonds immediately, the company may opt to raise funds of commercial papers and wait for more favorable environments in which to sell long-term bonds. Credit quality, U.S. Commercial versus Euro commercial paper. Corporate notes and bonds. Structured financial instruments. Structured financial instruments represent a broad sector of financial instruments. The sector includes asset-backed securities, ABS, and collateral debt obligations, or CDOs. CDOs are securities backed by a diversified pool of one or more debt obligations. And like ABS, they are discussed in the reading on asset-backed securities. A common attribute of all these financial instruments is that they repackage and redistribute risk. Our focus on this section is on structured financial instruments apart from ABS and CDOs. These instruments are typically have customized structure that often combine a bond and at least one derivative. Some of these instruments are called structurized products. The use of derivatives gives the holder of the structured financial instruments exposure to one or more underlying assets, such as equities, bonds, or commodities. The redemption value of are often the coupons. The structured financial instruments are linked through a formula to the performance of an underlying asset. Thus, the bonds payment features are replaced by non-traditional payoffs that are delivered not from the issuer's cash flow, but from the performance of the underlying asset. While there is no universally accepted taxonomy used to categorize structured financial instruments, we can present four broad categories of instruments in this reading: the capital protected instruments, the yield enhancement instrument, the participation instrument, the leveraged instrument. Short-term funding alternatives available to banks. Funding refers to the amount of money resources necessary to finance some specific project or enterprise. Accordingly, funding markets are markets in which debt issuers borrow to meet their financial needs. Companies have a range of funding alternatives, including bank loans, commercial papers, notes, and bonds. Financial institutions, such as banks, have larger financing needs, and non-financing companies because the nature of their operations. The section discusses the additional funding alternatives that are in their options. Let me drink my water real fast. I'm just drinking plain water today. Retail deposits, short-term wholesale funds. We got repurchases and reverse purchase agreements. These are all alternative ways in which funds or actually financial institutions may raise money. Okay, summary. Debt financing is an important source of funds for governments, government-related entities, financial institutions, non-financial companies, and non-financial companies. Well-functioning fixed income markets help ensure that the capital is allocated efficiently to its highest and best use globally. Important points include the following. The most widely used way to classify fixed income markets include the type of issuer, the bond's credit quality, maturity, currency denomination, the type of coupon, and where the bonds are issued and traded. Based on the type of issuer, the three major bond market sectors are the government and government-related sectors, the corporate sector, and the structured finance sector. The major issuer of bonds globally are governments and financial institutions. Investors make a distinction between investment-grade and high-yield bond markets based on the issuer's credit quality. Money markets are where securities with original maturities ranging from overnight to 1 year are traded. Whereas capital markets are where securities with original maturity longer than 1 year are issued and traded. The majority of bonds are denominated in either euros or US dollars. Investors make a distinction between bonds to pay a fixed rate versus a floating rate of interest. The coupon rate of floating rate bond is often expressed as a reference rate plus a spread. Interbank offer rates such as LIBOR are the most commonly used reference rates for floating rate debt and other financial instruments. Interbank offers rates are set of rates that reflect the rates at which banks believe they could borrow unsecured funds from other banks and the interbank market for different currencies and different maturities based on where the bonds are issued and traded. A distinction is made between domestic and international bond markets. The latter includes the Euro bond market, which falls outside the jurisdiction of any single country. And it's characterized by less reporting, regulatory, and tax constraints. Investors also make a distinction between developed and emerging bond markets. Fixed income indexes are used by investors and investment managers to describe bond markets or sectors and to evaluate performance of investment and investment managers. The largest investors in bonds include central banks, institutional investors such as pension funds, hedge funds, charitable foundations, and endowments, insurance companies, mutual funds, ETFs, and banks, and retail investors typically by means of indirect investment. Primary markets and markets in which issuers first sell bonds to investors to raise capital. Secondary markets are markets in which existing bonds are subsequently traded among investors. There are two mechanisms for issuing a bond in primary markets: a public offering, in which any member of the public may buy the bonds, or a private placement, in which only an investor or small group of investors may buy the bond, either directly from the issuer or through the investment bank. Public bonds issuing mechanisms include underwritten offerings, best effort offerings, self-registration, and auctions. When an investment bank underwrites a bond issue, it buys the entire issue and takes the risk of reselling it to investors or dealers. In contrast, in a best effort offering, the investment bank serves only as a broker and sells the bond issue only if it is able to do so. Underwritten and best effort offerings are frequently used in the issuance of corporate bonds. The underwriting process typically includes 6 phases: the determination of the funding needs, the selection of the underwriter, the structure and announcement of the bond offering, pricing, issuance, and closing. A self-registration is a method of issuing securities in which the issuer fills a single document with regulators that describe and allows for a range of future issuance. An auction is a public offering method that involves bidding, and that is helpful in providing price discovery and in allocating securities. It is frequently used in the issuance of sovereign bonds. Most bonds are traded in over the counter or OTC market. And institutional investors. Investors are the major buyers and sellers of bonds in security markets. Sovereign bonds are issued by national governments primarily for fiscal reasons. They take different names and forms depending on where they are issued, their maturities, and their coupon type. Most sovereign bonds are fixed rate bonds, although some national governments also issue floating rate bonds and inflation linked bonds. Local governments, quasi-government entities, and supranational agencies issue bonds which are named non-sovereign, quasi-government, and supranational bonds respectively. Companies raise debt in the form of bilateral loans, syndicated loans, commercial papers, notes and bonds. Commercial papers in a short-term unsecuritized security that is used by companies as a source of short-term and bridge financing. Investors in commercial papers are exposed on credit risk. Although defaults are rare, many issuers roll over their commercial papers on a regular basis. Corporate bonds and notes take different forms depending on the maturities, coupon payments, and principal repayment structures. Important considerations also include the collateral backings and contingency provisions. Medium-term notes are securities that are often offered continuously by investors by the agent of the issuer. They can have short-term or long-term maturities. The structured finance sectors include asset-backed securities, collateralized debt obligations, other structured financial instruments. All the seemingly disparate financial instruments share common attributes of repackaging risk. Many structured financial instruments are customized instruments that often combine bond and at least one derivative. The redemption and often the coupons of the structured financial statements are linked through a formula to the performance of the underlying asset or assets. Thus, the bond's payment features are replaced with non-traditional payoffs that are delivered not from the issuer's cash flow, but from the performance of the underlying asset. Capital protected yield enhancement, participation, and leveraged instruments are typically examples of structured financial instruments. Financial institutions have access to additional sources of funds, such as retail deposits, central bank funds, interbank funds, large denomination negotiable certificates of deposit, and repurchase agreements. A repurchase agreement is similar to the collateralized loan. It involves the sale of a security or a collateral with a simultaneous agreement by the seller, the borrower, or to buy the same security back from the purchaser or the lender. At an agreed on price in the future, repurchases agreements are the common source of funding for dealers, firms, and are also used borrow securities to implement short positions. And thus is reading 51. Remember, the show notes are in the description. You guys just go to the show notes and head on to Amazon. You guys should get the show notes. I do hope my readings have been helpful, and I hope to see you guys next time. We'll be continuing reading 52 about introduction into fixed income valuations. I do hope my readings have been helpful, and I hope to see you guys next time. Goodbye.